couple months. Are we in a breakout or a fake out?
No, we're in an up mode. There'll be layers in the process, but here's what happened. After the 2020 summer high, gold got up to $2,070. Okay, and then it went into a range. The lowest end of that range was in March of 2021, so about 9 months after the high.
Right.
He made a low in the 1670s. Shot back up in August, went back to 1670. Shot up again big in March of this year, went back up to the high, 2070 in price, and came back down. And again, you stopped in the sell-off like early summer, again in 1670, 3 times in a row. There's this line, the price chart guys could see it, 1670, 1670. So they defined a range, okay? And then we had what we predefined as a bear trap, meaning we're gonna blow that range, but not sustain, and then abort back up, clean out all the sell stops, turn everybody bearish. So what did gold do? Broke through 1670 in the summer, went down to 1617, and then aborted back above that stuff, saying, aha, trapped you. Okay?
Right.
It was convinced so many people that it was all over, gold's going to hell, it's no good, no good. And all of a sudden you end up closing the year unchanged on the year. Gold had a rally about 12% up on the year, sell off about 12% down, and ended up closing unchanged on the year. And right now we're trading about where we closed in 2021 again, 1830 area. Okay. So how come gold, it's a question people have to ask themselves, held steady last year? Despite that price chart fake out, it ended up holding steady. Silver closed up on a year 3%. And yet the S&P was down 20%, NASDAQ down 30%, T-bonds down 35%. Paper assets were collapsing, and gold said, I'm not going to join you.
Why was that?
Well, I think the reason is that it knows gold doesn't follow events. It anticipates events. That's my conclusion over many years. It knows that the central bank reversal to tighten, not just here, but ECB, and now even the BOJ trying to play the game, has broken the biggest paper asset bubble in U.S. history. How do I define that?
Right.
You go back to look at the 29 top from the 23 low, look at the 2000 .com high, look at the 2007 real estate peak. S&P was 1570, dropped to 670, And you look at all these bear markets that have occurred, they've come from bull markets that were doubles or triples. That's all. Since 2009 through 2021, the S&P went up 7-fold. NASDAQ 100, the leader index, went up 16-fold. You've never had bull markets in history of that dimension in that duration.
Right.
And if you go to the Fed Reserve St. Louis and look at some of their charts, look at M2, especially look at Fed funds rate, you could see they pushed money down to free levels and kept it submerged there for 5, 6, 7 years.
Right.
They kept stimulating all during and after the 2009 bear. They kept stimulating, and the river flow went into the stock market. So it created a bubble. Now, some major asset managers have determined in the last year that, the risk reward in the stock market is not so good. I'm going to start to move some of that money out. And that caused the stock market to top, and a lot of young investors came in late in 2021. They got loaded up at the highs. In January of this past year, we turned major bearish on the NASDAQ 100. Again, that's the leader index. It was 16-fold bull market. Okay,
Right.
That means Amazon, Apple, Microsoft. Those are the big weighted stocks there. And T-bonds were also in bear mode. So your 60-40 balance between 60% stocks, 40% bonds didn't work this time. It was a disaster. Bonds went down more than did the stock market even. So if you had that balanced, quote, portfolio, you got killed. And it's only just begun. Now, everybody thought, well, if the Fed's going to do this, then gold's going to go down. Well, it tried, but it didn't.
Right.
Silver tried, but it didn't. So coming up off the September lows in those markets, we defined sufficient trigger levels on momentum, not price, that said, okay, game back on again. It was a fake out.
Right.
That was a fake out. And sure enough, by the end of the year, here's silver yawning at up 3% on the year and gold unchanged, despite the quote, Fed fighting inflation. And the Bloomberg Commodity Index ended up 13% positive on the year. Even it was in a pullback, even. And it's still
that's right.
So those people who believe you can't fight the Fed, yes, you can, because the Fed screwed things up. One, they created the bubble. Two, they burst the bubble. And that bubble is going to continue to unwind. And as it unwinds, you're going to get economic and social ramifications, the kind that even the Fed can't ignore. Now, they'll be lagged to the events. That's the way they always are. They're always late. But there's some economists out there, Nouriel Roubini, for example, who's a Democrat, but he has warned that what the Fed has done is disastrous. It's going to be worse than anything we've imagined, and it's going to have social implications, in the street type implications.
Oh yeah, I agree.
Yeah, and well, we haven't seen that yet. Now today, for instance, we got this good unemployment stuff. You know, we got high employment. Yet Amazon just laid off 18,000 workers.
Yeah.
By the way, that's not unusual. There's a lot of major companies like that have been shopping big percentages.
And there's probably a lot of people who don't disclose it. A lot of companies who don't publicly come out and say they're laying off people.
Yeah. And by the time we see those numbers, it'll be lagged to reality. By the time you see unemployment say, oh my gosh, we're headed down, but the S&P will be 50% toward its bare low. You know.
Wow.
I think what gold sees and knows is that the central banks won't be able to continue what they're pretending to do, and they will have to revert back to what they're made for, namely support government bond markets. Now, Yellen, Secretary of Treasury, I think about 3 months ago, came out with a statement of concern. And she was concerned about the lack of liquidity in the U.S. government bond market.
Right.
Not just the price decline is sharp, but the fact that it's become an illiquid market. The most liquid, important market in the world, she defines as having become illiquid.
That's crazy.
That's the most dangerous word you can use in markets. That's what happened to mortgage-backed securities.